Bloomberg is now on your dashboard. With Apple CarPlay and Android Auto, it gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. It's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
I think everybody on their year ahead 2023 was saying the reopening of China was going to be a major, major play. It just doesn't feel like it's really played out. So, the question is kind of what happened and where do we go from here? Julia Leite, she joins us. She covers all the emerging markets for Bloomberg News. She's based in Sao Paulo, Brazil. Julia, again, the China call seemed like a reasonable call, seemed like an easy call to make a year ago. What happened?
And it was a total consensus call, right? We
Yes.
had Goldman, Morgan Stanley, Bank of America, everybody saying, China's going to reopen and kind of be a wave that lifts all boats. And it's super positive for emerging markets. And what you ended up seeing was the exact opposite, right? China has been a drag on emerging markets as a whole. If you look at it, the EM index, which is very, very heavy, China, it's about 30% China weighting. It's down 15%, underperforming U.S. stocks by the most in, I think, 35 years or something. If you strip China, it's up by the most in 4 years by about the same amount. So it ended up being a problem for those calling for the decade of emerging markets or, the beginning of a massive rally in EM, particularly because of China and it just all the hopes that with the COVID restrictions easing, it would lift everything, and it just didn't happen.
And that's why, for example, we're just getting a call out of Goldman, King Lau over there, head of global currency rates, emerging markets in general, saying, look, now think about EM and EM ex China going forward, it feels like.
That's right. It's a theme we keep seeing. We saw a couple weeks ago the EM ex China ETF just surging in inflows. It's now bigger than, the inflows are bigger than for the China ETF, which a few years ago was 50 times bigger than the ex-China ETF. So you're seeing a lot of money flow out of China in all asset classes and then it depends on the call, but you're seeing Latin America benefit, you're seeing a lot of India flows, a lot of money managers calling for, the growth prospects of India and the reforms, and just money just keeps flowing out of China.
So, Julia, I wonder what EM investors are saying today, because to me, as you mentioned, it's a big part of the MSCI, so you kind of have to be there. But to me, it feels almost uninvestable. This quote-unquote China risk, where the government can come in and just really wreak havoc on my business. I think about Alibaba, which is kind of the IBM of China. They just took Alibaba out to the woodshed. What are investors saying about the ability to invest in China these days?
And what you see a lot, too, is the surprises, right? I think the property crisis was a big nobody saw coming, and it wiped out $70 billion of value. So it is harder to invest. And what we're hearing from investors a lot is the gauges that we usually look at, so the MSCI EM for stocks, it's kind of losing its place as a benchmark just because you have to look at China and ex-China. And because this index is so heavy, it's kind of not representative of what's happening in emerging markets, where you're seeing a broad rally once you discount the 30% that's China.
I mean, just look at what happened on Friday of last week with the gaming sector.
Yes.
Tencent down
Yes.
12%. You saw NetEase down 16% in the ADR trading. I mean, extraordinary bait and switch, it felt like, once again, in terms of the overall view of gaming and whether or not you're going to be having to be charged if you're an adult using the gaming sector, in particular when you're making in-app purchases and the like. And then, of course, later China approves 105 new video games on Monday to try and sort of calm the concerns that it immediately rifled. So it does feel as though ultimately people are feeling very misguided by what happens with China. Ultimately, therefore, where do they invest? Is there any new country that we single out overall? Is there a viewpoint that you need to be elsewhere, Julia, at the moment?
I think the most consensus call at the moment is India. It's what we keep hearing from everyone. You have to invest in India. Saudi Arabia comes up a lot, as does Latin America. Brazil has been cutting rates. Chile has been cutting rates and kind of giving a boost to markets. Mexico is another destination. It's close to the U.S. You have a lot of companies moving factories into Mexico, which is a boom to the economy. So those are the geographies that we're hearing most about, while money managers leave China, kind of leave it alone for a little bit.
Julia Leite, so great to have some time with you. We really appreciate you dialing in from Latin America. You're, of course, based over there, thinking all things of managing editor for the EM Markets Americas.
You're listening to The Tape, Kantar Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Hagar Chemali, CEO and founder of Greenwich Media Strategies. Hagar, thanks so much for joining us here. I don't know where to start. In that part of the world, there are so many uncertainties here. It's such a fluid situation. Let's start with the Red Sea. What's the status of shipping in the Red Sea? Is everybody diverting, or are people taking their chances? Where are we?
Well, you had, as you heard, you had over the last few weeks, you had the Houthi militants in Yemen, which are backed by Iran and funded and armed by Iran, attacking vessels in the Red Sea, vessels, Israeli flagged ships, but also commercial ships of all kinds, in order to create trouble, in order to destabilize things, and frankly, is kind of an effort on the part of Iran, really, to destabilize things without declaring an all-out war and instigating a response from the United States, at least a major response. And so we had shipping companies say that they were going to divert traffic around Africa, which, as we all know, would increase costs majorly, and then also create delay times, could contribute to global inflation, and so on. And so the U.S. responded with saying, you know what, we're creating an international Navy coalition. And so the United States has a number of countries that have participated in that in order to patrol, if you will, the Red Sea and the Suez Canal to continue to allow shipping. And so they've created it. We don't have all the details on how many vessels or ships are there from the United States and which countries, but we do know that it has already diminished the risk. It hasn't decreased it entirely or eliminated it entirely, but it has decreased the risk. And already you have, as of yesterday, some shipping companies like Maersk, for example, have announced that they're going to resume shipping through the Red Sea and the Suez Canal. Not all of them yet, but I expect as people see that things are tad calmer, that they're going to resume shipping entirely.
So maybe that takes off some of the anxiety that we've seen from a price perspective shown in oil prices. However, the conflict as we see it, all of this stemming from, of course, conflict between Hamas, Israel, and I'm interested, of course, in ultimately how you see that particularly ramping up, because there has been increased concerns, particularly around Iran vis-a-vis Israel. How are we seeing that particularly ratcheting up its concerns for you as well?
Yeah, I don't see any let up in that conflict or in the aggression pursued by Israel. And by the way, also the aggression pursued by Hamas in this conflict. There have been, since last week, a number of efforts to try and reopen a truce. The Israeli president offered a one-week truce in exchange for another round of hostage and prisoner exchanges. Then Egypt has come up with a very ambitious plan that I don't think will stick for a more permanent ceasefire that would include even not only releasing hostages, but also changing the power structure in Gaza to include one that's a technocratic Palestinian government and not one led by Hamas, which Hamas outright rejected. Hamas has outright rejected both offers of these ceasefires. Now, I do think that you're going to see small humanitarian pauses and truces that are short in nature, again, because we know that Hamas and the Israeli government have agreed in principle in already to humanitarian pauses that yield a Palestinian prisoner / hostage, Israeli hostage exchange, right? So I bet we'll see that again. But in the meantime, until that happens, the Israeli government, and Netanyahu has been very public about this, has said that there's really no let up. Netanyahu just yesterday or 2 days ago said that there is no stop to what we're seeing on the ground in Gaza. And I will tell you, in my own experience, when I worked at the White House working on conflicts, including past conflicts between Israel and Hamas. These wars are short in the grand scheme of wars. And so I don't expect it to last at this intensely past the new year. I mean, into the new year, maybe a month or so. But after that, I expect somewhere around February, it'll die down. But it will not stop until the Israeli government really gets at the heart of Hamas's leadership in Khan Yunis in the south of Gaza.
Hagar, what's the support for President Netanyahu at this point? And I guess by extension, just the overall war effort here. Where are we in that right now? That's
a great question. Israelis have really spoken very loudly against Netanyahu. And by the way, they were speaking loudly against him before October 7th because of his own corruption scandals, because of how he was trying to overhaul the judiciary inside Israel in order to protect himself from these corruption investigations. And so there was already a lot of animosity toward him, a lot of protests against him. And this has only increased that sentiment further because a lot of his policies created the vulnerabilities that Hamas took advantage of when they went and pursued their horrific terrorist attack on October 7th. But that said, they are in the middle of this intense war. And so while you have what seems to be a majority of Israelis, and there's been a lot of Israeli polling on that, against Netanyahu and more in favor of Benny Gantz, who is in the wartime cabinet, I don't expect Netanyahu to leave or resign or be forced out at this moment. But like I said, when those intense operations slow down a bit, which I expect sometime after the new year, that's when the Israelis will turn and say, all right, now it's time to kick Netanyahu out, and I expect Benny Gantz to be put in place.
Wow. Hagar, what then of the administration? We, of course, are heading towards an election in 2024. With your 12 years of experience of working within government, what will the response level end up being from the White House at the moment?
I don't expect the position of the White House when it comes to calling for a ceasefire or to place conditions on U.S. aid to Israel to change at all. And some of it could be because they're banking on the fact that it will be short-lived, and it will be. Like I said, in the grand scheme of how wars go around the world and in history, these wars between Israel and Hamas tend to be relatively short. And so they may be banking on that, but a lot of it really does stem from a genuine desire to defeat Hamas completely, a belief that the Israeli government can do so. And by the way, I agree with that, given that we saw it happen with the international coalition against ISIS. That might not mean that they could eradicate Hamas completely the way Netanyahu says, but defeating Hamas and its military and governing capabilities is a real achievable goal, in my opinion. And you can see that the Biden administration wants that. And they also don't want to show any kind of lack of support for Israel at this time. And that's why they're not going to place additional conditions that already exist on the weaponry, equipment, vehicles going to Israel. That said, you do see them heightening this rhetoric on the U.S. side, calling on Israel to really limit or avoid civilian casualties at all costs, to be as targeted as possible, to transfer to low intensity operations. And that's because not only is that morally the right thing to do, but in terms of the strategic goal of a broader, secure Israeli state, that harming civilians this way, killing them this way, doesn't help them achieve that goal. It, as Lloyd Austin says, Secretary Austin, it would replace a tactical victory with a strategic defeat. And that's why you see the U.S. continuing to advise in this way.
So, Hagar, the Middle East is not the only hot spot out there. We still have the war in Ukraine. And I spoke to Admiral James Stavridis a couple of weeks ago, the former NATO chairman, and he said basically he had just returned from Korea. And he said what he believes is going to have to happen in Ukraine is what happened in Korea in 1952 or 53, which is basically swapping land for peace. Is there any feeling in that part of the world that that's even on the table or is possible? What's the update?
Well, it's not the feeling certainly coming from Ukraine. And it's not entirely yet the feeling in Europe, though you see things starting to become a little bit awkward or uncomfortable, if you will. So on that, so first of all, I'm so glad you're asking about Ukraine, because nobody is really. And just because the attention has diverted to Israel and Gaza does not mean that the war there has let up at all. Things there seem to be in somewhat of a stalemate, though I have to really stress that while you see a lot of press articles saying that Ukraine is losing its counteroffensive, that is not true. In July, Ukraine Ukraine had regained 50% of the territory that Russia had seized since February 2022. And that is significant. That said, they are running out of ammunition, and we know that. And President Zelensky came to the United States and pleaded to Congress for more aid. A lot of experts say that they'll run out by March. Now, that said, I do believe at the beginning of this year, at the beginning of 2024, that Congress will pass a new round of aid for Ukraine, for Israel, and also for the southern border, which is what Republicans have said is holding up aid. They want to compromise on that. President Biden has said he's going to compromise on that, and I think they will. I think they'll come to an agreement. But that said, it shows that things are becoming more difficult in garnering support for Ukraine, and that is in part because it's an election year. Americans are growing a bit more weary. Not a lot, not the majority, but a lot are growing more weary of support for Ukraine. Obviously, you have inflation. And in Europe, you're seeing the same. The Hungarian Prime Minister, Viktor Orban, he got in the way of the EU sending another aid package to Ukraine. The EU requires consensus of all of its 27 member states in order to pass something like that. And so you're seeing difficulties arise. Like I said, they will get there. They'll cross the finish line in the new year. But given how difficult it's becoming, I'm not surprised that you're starting to see leaders say, hey, we don't want to leave Ukraine in the lurk like this. And so maybe we need to start considering how to lay the groundwork for negotiations and position Ukraine in as strong a position as possible.
Hagar, thanks so much for joining us. Really, really appreciate getting your perspective. Hagar Chemali, CEO and founder of Greenwich Media Strategies. She's also an adjunct professor at Columbia University School of International and Public Affairs and a non-resident senior fellow at the Atlantic Council's Geoeconomics Center.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We want to be bringing in Jennifer Lee, senior economist at BMO Capital Markets. And Jennifer, it has been an extraordinary year. If you think about the way in which basically every economist got it wrong in the direction of travel of, well, how far we'd go in terms of borrowing costs going higher. They never anticipated quite the ramp up. But now we see every economist thinking that we're going to be cutting in extraordinary degree. Well, the markets see at least 150 basis points, 1.5% for the next year. We feel as though the market's getting ahead of itself when it comes to overall Federal Reserve policy, or what do you make of it?
Good morning, and thank you for having me on. Yes, I think the market is a little bit ahead of itself, to put it gently. There's still some talk about earlier rate cuts for the Federal Reserve, but I don't see how that's going to happen. Short of something dramatic happening. We do look for rate cuts to come around the middle part of the year at about 100 basis points. In total, it's just we've gotten so much momentum still building up. I mean, even though we saw third quarter growth, and it seems like forever ago, revised down last week to 4.9%. That's still a heck of a strong number. There's no denying that. And that was, by the way, the very first estimate that the BEA came out was 4.9%. So 4.9%. Q4 so far, we've seen signs of slowing, but there is still a lot of momentum. And, it seems like forever ago, but just last week we saw the personal spending and income data. Holy cow, still very strong, 0.3% real spending. And it was basically across the board. And I always look at the key things, that people could be spending on or would not be spending on if they're really, really worried. And there's still more spending on dining out. There's a lot more spending on recreational goods and vehicles, things like that, if things were really, really tough, you wouldn't be doing all that. And there's still some spending on that front. So we are still seeing some decent momentum moving into the fourth quarter and into the turn of the year. So again, earlier rate cuts, I think, are just overblown, that sort of talk.
Interesting. So if we do see still that resilience, if we do see ultimately also maybe wage inflation being sustained, do you ultimately think that the Fed will have to become more joined up in its approach and messaging as well? Because that's where the whiplash seems to be coming in. We have Fed Chair Powell speaking of perhaps this necessity to start cutting in 2024, and then a couple of Fed speak come out and try and wheel us back in terms of how far, how fast. Are we getting a consistent message?
Up until recently, I would say yes, but now it's like I don't know what happened at that Fed meeting, but obviously Fed Chair Powell, I feel, took threw the markets for a loop when he started talking about the fact that rate cuts had entered the discussion, and he didn't really push back on too much of the questioning that he got during the Q&A. So that's why we saw that parade of I believe it was every single Fed official coming out shortly after saying, hold up, way too soon. Discussion of earlier rate cuts is too premature. We still have to see a lot more data. Everything is going, again, we're looking at the totality of the data as we keep talking about all the time. And I think there's going to be a lot more of that before we can see the official rate cuts. But, it's going to, we do believe it's going to happen again mid part of 2024, which is around the corner at this point. But the fact that, things are slowly slowing, and the fact that inflation is coming down, it's a good place to be in right now. And this is something that I don't think any of us would have anticipated a year ago.
So, Jennifer, can we officially take the recession talk off the table?
I'm going to say this again, we've always been in that soft landing category. And we had, I think, a negative print at one point last year, but we took that all out. Again, this is like the whole soft landing, no landing, any landing kind of scenario. We still see things slowing, obviously, around the turn of this year. And this is going to prompt those Fed rate cuts to come along around June. But I don't think a hard landing or actual recession is right now looks like it's in the cards. But things can change very, very quickly. A lot of uncertainty that's playing out there as 2024 begins. So we'll see how all that plays out. But as of right now, we are not looking for an actual full-fledged recession.
Jennifer, I don't know, just in my opinion, I think the Fed's done a decent job here. I mean, coming out of a pandemic, which they didn't teach you in business school. Maybe a little bit late. Okay, I'll give you that. But by and large, they seem to have managed this thing pretty well. If in fact we do get a soft landing, what's your feeling here? Is now we have a little bit of hindsight?
I'm going to 100% agree with you on that. I mean, the fact that, again, we are at this stage at the last few days of December of 2023, and that whole soft landing narrative is still continuing to play out, and more people have hopped on it over the last few months. And this is something, I guess, again, no one would have imagined. Unemployment is still very, very tight. Wage growth is still on the rise, but not as hot as it once was. So this is, dare I say, it's almost Goldilocks-ish. This is something that the Fed is totally welcoming, and for sure, it seems like they've done a great job. And the fact that the U.S. economy remains resilient after over 525 basis points of rate hikes is pretty darn good. I mean, I think they should be giving themselves a pat on the back. But again, it ain't over until it's over. And we're going to have to see how, 2024 plays out if we start seeing more signs of potential, more heavier braking, I guess, on the economic momentum front.
And let's just talk about some of those risk factors, not to be a Debbie Downer at the end of our conversation, but just tell us a little bit about what is it that you think could pull back a consumer at this moment, which does seem to be so resilient? Is it geopolitics? Is it tensions in the Middle East? What is it that suddenly upends some of these rosier viewpoints when it comes to a soft landing?
I'm going to say all of the above. I mean, if consumers starts seeing more signs of, potential, even like supply chain issues coming back into the mix, China's opening again and all that. So that's fine. But then now we've got everything that's happening in the Red Sea. There's a story this morning about Europe, trying to create its own battery chain, scenario, and it's having problems sourcing supplies or components because of competition from the U.S. So that could also throw a wrench into that. And of course, as you mentioned, geopolitics, the war in Ukraine, of course, the conflict in the Middle East. If that ramps up, we also have a number of elections coming up in 2024. We have, I'm not the political expert, of course, but we've got Taiwan coming up in January, and of course the whole series of European elections during the year. And then, of course, we've got the U.S. coming up in November, and all of these could throw a big wrench in all of this. I always like to look at climate as well. I mean, this is something that it seemed like a very far away story a couple of years ago, but it's still very much here. We can see it from, we here in Toronto, we have like a green Christmas, which is something I haven't seen in a long time. This is all could potentially add to the whole inflationary pressures in terms of how it affects food prices, for example, and energy.
Jennifer Lee, thanks so much for joining us. Jennifer Lee from Bank of Montreal, BMO, as we know it in the trades, giving us her thoughts on this economy. Looks like a pretty solid soft landing at this point.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Julie Van Ullen is joining us. She is Chief Revenue Officer at Rakuten Rewards. Now, Rakuten Rewards, I'm thinking of cashback, I'm thinking of coupons, I'm thinking, though, of you being able to track consumer sentiment as it stands online in particular. And Julie, is the consumer as resilient as it was this time last year when it comes to e-commerce purchasing?
It's a great question. And first, it was a massive holiday season, especially for brands like us who cultivate great loyalty via incentives, rewards, discounts, coupons. But unlike the last couple of holiday shopping seasons, we had to wait until the very last minute to see those consumer dollars flow through, which is obviously a scary moment when you consider how much spend flows through Q4 normally. Last couple of years, shopping really started in October, November. In earnest, this year, it really started on Cyber Week, which we kind of anticipated would happen and luckily did happen, knowing that consumers would likely be waiting for the best possible deals. But what I will say is particularly interesting is that because consumers waited, there was a lot of pent-up demand that rolled into December. But that made it quite hard for many retailers and brands to sustain that sort of promotional activity through end of year. So some were smart with their budgets, some less smart, and it did really create some winners and losers.
Okay, let's talk about the winners. Who won?
From a category standpoint, I would say there are some interesting things. Travel really did quite well, ostensibly because consumers were waiting for the best deals on high price point purchases. We thought electronics would be a big winner. Not so much. They did start to come back a little bit in December, but given those are discretionary purchases, we did think that those dollars would wait for the big deals to occur. Apparel was another one that wasn't so super, ostensibly again, because that's a bit discretionary. People aren't gifting apparel as much. It's more something for yourself that you might want and not need. On the other hand, we saw incredible growth coming out of department stores, marketplaces, footwear, toys. So really, apparel and electronics was the only two that were a tad lackluster, I'll say.
Well, against my better judgment, Caroline, I bought an Xbox for one of my offspring, and I did it begrudgingly, but he had earned it. He had a pretty good year. All right, so Julie, I mean, how do we feel about the consumer here? Because I'm not sure how the consumer is paying for all this stuff. What are the retailers telling you about credit and that type of thing?
Yeah. So, I mean, we see consumer spending, right? You know, you just listed the stats for us there, but I think we have to remember that consumers are spending, but they're looking for the best value. So, but that's really putting brand loyalty into question. So you see a lot of retailers and brands really scrambling to try to figure out what does this mean for how they retain shoppers going forward. And while there are certainly signs of inflation cooling, I think that there are many facets of our current economy, political landscape, a lot going to be happening in the next year that's going to mean that consumers are still very, very value driven, which is going to create a challenge, a juxtaposition, if you will, for retailers who I think at the beginning of the year, you're going to hear a lot of retailers looking to return to health, which is going to mean they're looking for better profit margins coming out of a very competitive, high promotional Q4.
Well, that's kind of where I want to go, Julie. I mean, I hear a lot about consumers seeking value and promotions and things. So what does that mean for the retailers' margins?
It's a challenge, right? They usually are used to having to give quite a lot away in Q4. And then come Q1, there's an ability to recoup those healthy margins. And that's even more important now coming off of COVID when loyalty really was in question and consumer and retailers have been spending to earn back shoppers for the last couple of years. So this return to health is important. And there are a couple of things that they can do to meet a shopper where they are while still offering incentives. Things like cashback. Cashback is a great lever for allowing a retailer to charge regular price, but create an incentive for a shopper. And even though I know you said you didn't go in store too much to shop this holiday season, that is a big and growing arena, especially for younger shoppers.
Yep.
So another area that retailers can think to invest is in incentivizing things like buy online, pick up in store, where they can give an incentive there, but drive consumers to shop where they know that they'll get additional purchases once those consumers are in the store.
All right, Julie, thank you so much for joining us. As always, appreciate getting a few minutes of your time. Julie Van Ullen, she is the Chief Revenue Officer at Rakuten Rewards, giving us the latest lowdown on what has been a pretty solid holiday shopping season.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.